In 1873, the United States quietly altered the foundation of its monetary system, and almost no one realized what had happened. There were no riots, no dramatic speeches, no headlines warning the public. Congress passed a technical change to the nation's coinage laws that seemed insignificant at the time. Yet that single decision would later be remembered by millions as one of the most controversial financial acts in American history. It came to be known as the Crime of 1873. Not because it involved violence or corruption in plain sight, but because of what it took away without public consent: silver's role as money. For most of American history, money was not abstract. It wasn't numbers on a screen or promises backed by policy. It was metal. Gold and silver had real weight, real limits, and real meaning. Under the bimetallic system, both metals were legal money, coined by the government at a fixed ratio. Silver was the currency of everyday life. It paid wages, settled small debts, and flowed through local markets. Gold was used for large transactions, international trade, and banking reserves. Together, they formed a balance that had existed for centuries across civilizations. That balance began to fracture in the mid-19th century. Across Europe, powerful financial centers were abandoning silver and embracing gold alone. Britain had already committed to a gold standard, and its global influence helped frame gold as modern, efficient, and international. Silver, by comparison, was portrayed as outdated and inconvenient. When American lawmakers began revising the nation's coinage laws after the Civil War, they increasingly looked to Europe as a model. Quietly, deliberately, silver was pushed aside. The Coinage Act of 1873 removed the standard silver dollar from the list of coins that could be freely minted. To the public, it appeared to be a minor administrative update. Silver dollars were not widely circulating at the time, so few people noticed their disappearance. But the legal consequences were enormous. From that moment forward, Americans could no longer bring silver to the U.S. Mint and have it coined into legal tender. A right that had existed since the nation's founding vanished with the stroke of a pen. The economic effects did not appear overnight, but they were relentless. For decades, silver and gold had been linked at a stable ratio of roughly 16 ounces of silver to 1 ounce of gold. Once silver lost its monetary status, that balance collapsed. As more countries followed gold-only systems, the demand for silver fell sharply. Its price declined year after year. Anyone who owned silver, farmers, miners, wage earners, saw their wealth steadily lose value. At the same time, those who held gold or gold-based financial assets found themselves growing richer without lifting a finger. This was not an accident of nature. It was the predictable outcome of a deflationary system. When money becomes scarcer, each unit gains value. That benefits creditors and lenders, because debts are repaid in more valuable dollars. For borrowers, the opposite is true. Their debts grow heavier, even as prices and wages fall. Throughout the 1870s and 1880s, American farmers and small producers found themselves trapped. Crops sold for less, loans stayed the same, and foreclosure became common. What became known as the Long Depression was not caused by a single crash, but by a slow, grinding contraction of money itself. Anger spread across rural America. People didn't speak in terms of monetary theory, but they understood injustice. They knew something had changed, and that it wasn't in their favor. Many became convinced that silver had been deliberately sacrificed to benefit banks and financial elites. Whether driven by conspiracy or coincidence, the outcome was clear. Wealth flowed upward. Opportunity narrowed. Credit tightened. The monetary system no longer served the majority. Out of this hardship grew the free silver movement. Its supporters demanded the restoration of silver as legal money, freely coined alongside gold at a fixed ratio. They believed that expanding the money supply would raise prices, ease debts, and revive the economy. Farmers in the Midwest, miners in the West, and laborers across the country found common cause. For them, silver was not just metal, it was survival. Opposition was fierce. Defenders of gold argued that expanding silver would weaken the dollar and destroy confidence. They warned of inflation, chaos, and financial collapse. Behind those warnings stood powerful interest banks, industrialists, and international creditors who benefited from scarcity. What looked like a technical debate over currency ratios was, in reality, a struggle over who controlled the economy. By the 1890s, the conflict had become political. New parties formed. Old ones fractured. The question of money dominated elections and speeches. The movement reached its peak when a young politician electrified the nation by condemning the gold standard as a weapon against working people. His words transformed silver from a regional issue into a national crusade. For the first time, millions believed change was possible. But power rarely surrenders quietly. Financial interests mobilized immense resources to protect the gold standard. Media campaigns framed reformers as dangerous radicals. Fear proved effective. The gold-backed system survived, and the free silver movement faded. Yet the questions it raised did not disappear. They resurfaced whenever economies contracted, debts grew unbearable, or wealth concentrated too tightly at the top. Ironically, gold itself proved far less stable than promised. New discoveries increased supply and eased deflation temporarily. Wars shattered the system entirely. Governments abandoned gold when it became inconvenient, and returned to it only when it suited them. By the early 20th century, the rigid monetary world created in 1873 was already cracking. When the Great Depression struck, the logic of scarcity returned with devastating force. Deflation destroyed businesses and livelihoods, while policymakers clung to outdated monetary rules. It took a crisis of unprecedented scale to finally break the system. In the 1930s, gold was stripped of its domestic role, and money became a matter of government decree rather than metal. The world moved from scarcity to managed abundance, from silver and gold to credit and control. Yet the legacy of 1873 never vanished. Every modern debate over inflation, debt, and monetary authority echoes the same conflict. Who benefits when money is tightened? Who pays when systems fail? The demonetization of silver was not just a historical event. It was a turning point that revealed a deeper truth. Money is never neutral. It reflects power, priorities, and control. The real crime of 1873 was not simply removing silver from circulation. It was proving that money could be quietly redesigned in ways most people would never understand, yet everyone would feel. It marked the moment financial systems became tools of influence rather than shared foundations. From silver coins to digital ledgers, the technology changes, but the struggle remains the same. Because whoever controls money doesn't just control markets. They shape societies, futures, and lives.